Financial statements will have ratios and calculations that you'll want to pay specific attention to. First, the debt to equity ratio is a company's total debt to the company's total shareholder equity. Now, different ratios are desirable for the debt to equity depending on what industry you're in. A debt equity ratio of 2 to 1 means that the company has $2 of debt to every single dollar of shareholder investment. In other words, the company is taking on debt twice the rate that its owners are investing in the company. Then you have inventory turnover ratio, and this is the cost of sales compared to the average inventory for the period. Next, we'll talk about operating margin, and this is a company's operating income compared to its net revenue. Basically, income from operations or net revenues are expressed as a percentage. For each dollar of sales, what percentage was pure profit? Then, we've got the P/E ratio, and this compares a company's common stock price with its earnings per share. Basically, you're looking at price per share versus earnings per share. If a company's stock is selling at $20 per share and the company is earning $2 per share, then the company's P/E ratio is 10 to 1. The company's stock is selling for 10 times what it's earning. There are 3 common measures within financial statements. The first is liquidity. Liquidity is your ability to pay your obligations over the short term. Next is solvency, and this is the company's ability to survive over a long period of time. And third, the profitability, and this is the operating success over a specific period of time. So we'll discuss liquidity a little bit. Liquidity may be seen as working capital. This is your current assets minus your current liabilities. It is often an indicator in your ability to pay something quickly. You think about it, what is a current ratio? A current ratio is your current assets divided by your current liabilities. And this is your short-term ability to pay your obligations. Your recommended current ratio should be 2 to 1. Solvency is your debt to total assets ratio. It may be measured as dividing total liabilities by total assets. This measures your ability to survive over a longer period of time. And you want your total debt to total assets ratio to be less than 1, but this number can be too low. Your business's profitability is usually measured by 3 different ratios. The first ratio is return on assets ratio. This is where you take your net income and divide it by the average total assets. Your assets are averaged with their beginning and ending value. The second is the dividend yield ratio. This is where your cash dividend per share is divided by the year-end stock price and is usually used to measure corporate performance. The third one is the asset turnover ratio. This is where your net sales are divided by your average total assets. And this is usually used to measure the efficiency in the use of your assets for your business. Forma refers to practice or documents that are completed out of formality. They're usually done to satisfy minimum requirements or standards. A funds flow analysis or a hypothetical statement of future may help you make projections for the decisions of the future. Usually these are based on income statements, balance sheets, and sometimes it's recommended that you do these monthly for a small business. Within these documents or these practices, there are some things you might want to address within your small business. What is happening with your current assets? What is happening with your fixed assets? Are there any changes in your income? How can you finance growth? Did your business show a profit or a loss? And what portion of resources were provided by the operations as compared to the investment? What is the difference between a creditor and an investor? It can be summed up as follows. If a bank makes a loan to a company and the company triples or quadruples their earnings, the return the bank enjoys will be the same as if the company never grew a percentage point at all. For the equity investor, meteoric growth spells great success. What you want to consider is the bottom line. What are your financial statements telling investors or creditors about your company?